As we prepare for a Fed statement this week, the stock market bulls have very little margin of error. In this week's video, we cover key S&P 500 levels the bulls need to hold in order to avoid what could be a more prolonged correction in stocks. In the charts and slides that follow this week, we'll cover key support levels for the S&P 500. We'll look at Fibonacci retracement levels from a weekly perspective. We'll revisit the technical profile of the current stock market relative to two vulnerable periods in 2012 where downside risks increased. We'll look at the CCM models, what our allocations are called for based on our rules. These charts, longs versus short, stocks versus bonds. We'll look at the VIX, credit markets, and more. The moral of the story this week is and will be if the S&P 500 can hold above the 1593-ish to 1613-ish levels. Some patience is in order with long positions. If these levels or this region is broken, additional defensive action may be needed, and there may be an opportunity in risk-off assets such as bonds or hedging instruments. For CCM clients and those who follow our work, we may be a little quiet on a relative basis on Twitter and our short takes this week. We're back testing our disciplined rules-based system. It's a very tedious and time-consuming process, but we are very confident this will help immensely going forward. We'll use these rules and the recommended allocations in future videos on short takes and in Twitter. This weekend we've been looking at the 2005 and 2006 data from a back testing and tweaking perspective. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. This is a daily chart of the S&P 500 index. I'm going to make 5 points here. Point number 1, this trend line acted as support down here in the lower left hand corner. Acted as support again here. If you follow it up, it's still in the picture here. That's trend line A. Trend line B acted as resistance. Stall here. Support. Support. If I follow that trend line along, it's still in the picture. That's point 2. Point 3. 1593 acted as resistance on a closing basis here. 1597 acted as resistance short term there. Therefore, what once was resistance may now act as support. And the last point is the 50-day moving average here in blue in the upper left-hand corner as of Friday's close on June 14th, set at 1613 and change. Held near the 50 down here in the lower left-hand corner. Held above the 50 here. Bounced at the 50 here where the green arrow is. If we follow the 50-day moving average up, it is also in the picture. Moral of the story, if we stay above all of these levels, we're not overly concerned. If we move below 1593 and into this red box, our concerns increase. We do have some potential support here. The 200-day moving average comes in at 1500 and change. You'll note the 50-day moving average still has a positive slope. Our concerns would increase even more if price moves into this area here and the 50-day starts to roll over in a bearish manner. This is an S&P 500 weekly chart. This is the November 2012 low. This is the recent peak in May of this year. These blue lines show Fibonacci retracement levels from this move here to this peak here. If we retrace 38.2% of this move, it takes you to roughly 1550, 1549-ish. Here, a 50% retracement is at 1513 and change, and a 61.8 or 62% retracement in round figures takes you to 1477. We also have this upward sloping trend line that comes into play somewhere above 1590. There's another upward sloping trend line that comes into play below 1610 in the 1600 area. This, on a closing basis, acted as resistance at 1588, and on a closing basis on a weekly chart, this acted as support at 1553. Concerns increase if you move into this area, especially on a weekly closing basis, and would pick up even more with a weekly close below 1553 on the S&P 500 weekly. This is a chart we've looked at in the past. This is the year 2000 here, resistance, 2007 resistance, bullish breakout here. The levels to watch as potential support would obviously be this blue line. The low for this month, this is a monthly chart, in June of 2013. So far, though, in June is 1598.23. If you're a bull, you would prefer to have that level hold. The low from the month of May here was 1581, is another important level if we see weakness going forward. This is a daily chart of the S&P 500 index. This is the year 2012. This is January. This is the end of 2012 here in late December. We've covered this chart in detail. If you want more commentary on it, you can find this video here on the Schiavocco Capital channel. Just to remind you what we were looking at, our concerns were we would want to avoid a period like this, which was May 4th, 2012, where the declines accelerated to the downside. And here on October 19th, 2012, the correction accelerated to the downside. So we'll look at the technical profile on this date and on this date in 2012 and compare it to the close last Friday. One more point here. Notice when the correction picks up steam, this is the 50-day moving average in blue here. Bad sign when you slice through the 50-day moving average in a violent manner like this, as we did in May of 2012, and simultaneously the 50-day moving average rolls over. You'll notice here we never revisited, retested, or did anything with the 50-day. We just fell. Here, when we went through the 50-day, it was still sloping upward and it flattened out. Also notice that we came back up and at least retested the 50-day. Moral of the story is, when the 50-day rolls over and you're below it, correction odds increase. Below the 50 rolls over, correction odds, or a more precipitous or rapid drop, the odds of that increase. As of the close on Friday, our 50-day has not rolled over yet. It's just something to watch. Now let's look at this date and compare the technical profile to last Friday's close. This is an update to a table we've reviewed in the past to get a detailed description of what this table tells you. You can find this May 25th video, find these segments. This is how you find the video. But basically what we're looking at is a component of the CCM models that derives a composite technical score for these charts. This is the most important, SPY. It carries the highest weight in the model. This is the least important, the number of stocks above their 200-day moving average, and it carries the lowest weight. Point of the exercise, the technical score, the scale is 0 to 100. So a score of 100 tells you that's the most bullish conditions that you can have from a technical perspective. A scale of 0 would be a very oversold or bearish technical profile. These are the dates that we just looked at in 2012 when the market was vulnerable to accelerating to the downside. The technical profile on October 19th, prior to an acceleration of the declines, was a 33. That's a weak score. In May of 2012, it was a 17. Our score has now dropped closer to those levels as of the close on June 14th at a 44. On the 24th of May of this year, we were in 82. A week later, we dropped to 72. And now we're all the way down to 44, which means the bulls do not have much margin for error, and it's prudent to have a defensive game plan ready to go. Our rules say that our allocation in May of this year on the 24th had to fall between a risk allocation of 84 to 94%. On the 31st, it dropped down to 80 to 90. And as of the close last Friday, we're all the way down to 73 to 83% is where we need to be. If this market accelerates to the downside as it did here, the models will allow us to step away at a faster rate. This is a weekly chart of the S&P 500. It's one of the big four charts used in the CCM models. This is as of the close on Friday, June 14th. This is the S&P 500 here. This is what correction in the stock market. The moving averages help us discern trends and discern between volatility that should be ignored and volatility that should be respected. You can see when corrections take place in the stock market, you tend to get a bearish moving average crossover where blue goes below red. Blue below red, price below both. Blue below red, price below both. You can see as of Friday's close, as we've mentioned previously in this video, the bulls have very little margin for error. Price closed below both moving averages, and the blue moving average just barely held above the red moving average on Friday. If this look morphs into something like this, especially as of next Friday's close, or this, our concerns about acceleration to the downside would increase. This is a vulnerable look for the S&P 500 weekly. This is a chart we've described in the past. This is the HDGE risk off divided by risk on. This is what risk on looks like. This is what risk off looks like when the S&P 500 corrects. Risk off, S&P 500 corrects. You can see when the ratio of HDGE relative to the S&P 500 starts to rise, moves above and gets a bullish moving average crossover as it did here, the odds of corrective activity in the stock market increase. Ratio rising, correction. You can see this is a very vulnerable look for the stock market. Bulls, if this look here morphs into something like this or this, our concerns about acceleration to the downside would increase. This says have defensive game plans close by next week. It's another chart used in the CCM Big Four charts. This is longs S&P 500 relative to shorts. When the ratio is rising, that's what risk on looks like. This is the S&P 500. When the ratio falls, here's the ratio. This is what the S&P 500 looks like during a correction. Ratio gets weak. Same concepts. This is a bearish look. Bearish moving average crossover, blue below red, price below both. You can see here, price closed below both. Blue is holding just barely above red as of the close on Friday, June 14th. This is a very vulnerable look that could easily morph into something like this, where declines in the stock market followed. This is a chart we've looked at many times in the past. This is risk on SPY weekly relative to risk off intermediate term treasuries, or IEF, up here in the left-hand side of your screen. Point of the exercise: if the ratio, this is what risk on looks like, this is what risk off looks like, consolidation, correction in stocks. If the ratio takes on a risk off look like this, where the stock market consolidates and or corrects, we do have potential support from this pink line here that acted as resistance, and numerous trend lines in this area. Now this chart still has a bullish look, moving averages pointing up, price above, blue above red. If we morph into something like this, which we may, our concerns would increase. This is another bond versus stock chart. This is AGG weekly relative to the S&P 500. This is what risk on looks like when the ratio is falling and the stock market rises. This is what risk off looks like when the ratio rises. The stock market tends to consolidate and correct. Ratio rises, stock market consolidates, and finally corrects. This is the look we don't want if you're a stock market bull. Bulls don't want this look here. That's where the corrections in the stock market followed. We don't have that look yet. Point of showing it, however, we do have what could be a W-type bottom for bonds relative to stocks, or a double bottom here. This is a look that you need to respect. This tells us it's possible that bonds are setting up for another period of outperformance. We're not quite there yet, but it's something we need to respect going into next week. Same concepts here, we're just flipping it around and taking a step back and a longer term look. In this case, we've got risk on relative to risk off, S&P 500 relative to the aggregate bond ETF AGG. When the ratio is rising in this case, that's what risk on looks like. This is the S&P 500. When the ratio consolidates and falls, the S&P 500 tends to consolidate and fall. Point of the exercise, vulnerable look. That's your W bottom inverted now, and it looks almost like a double top. Haven't rolled over here yet. If this look here morphs into something like this or this, our concerns about a stock market correction would increase. This looks vulnerable, and we need to be ready for potential declines, especially if 1593-ish on the S&P 500 gives away. Above 1593 and above the 50-day moving average on the S&P 500, some patience is in order. 2 or 3 weeks ago, we did note that one chart, the S&P 500 risk on relative to the VIX, did look vulnerable. You can see this chart has been consolidating here for weeks, really hasn't made any progress in the bull's favor. Point of showing it, S&P 500 accelerated to the downside here, and you'll notice when that happens, this ratio has the bearish look. Blue below red, moving averages rolling over, price below both. Blue below red, moving averages rolling over, price below both. We have that look today, which again tells us to be ready for the potential for further weakness if support gives way. Price and support are the most important thing. You don't make a decision with your allocation based on this. This tells you to be ready and prepared to take defensive action if price confirms it on the S&P 500. This is another weekly chart used in the CCM list of Big Four charts. This is risk on JNK bonds relative to more conservative treasuries when the ratio is rising. That's what risk on looks like when the ratio consolidates and falls. The S&P 500 tends to struggle, as it did here and as it did here. Point of the exercise. This look is the most concerning. Price below both, blue below red, slopes down. This is more of a consolidation look. Finally broke away here. The stock market was accelerating to the downside already. So this is a concerning, somewhat consolidation look. If this continues to weaken next week, our concerns would increase. The only thing about this that still looks fairly decent is there is a lot of white space here between these moving averages, as you maybe had here. So if we saw a sharp decline as we did here, our concerns may increase. Credit markets don't look too bad yet, but they might be ready to roll over. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.